Hello, greetings. Welcome to Dividend Blasters. This is our 107th video. Our topic today, invest in gold and earn monthly income. So we know that when we buy physical gold, we will not generate any income. It's all price appreciation. We're totally dependent on how the price of gold is performing in the market. There is no cash flow. There is no dividend. There's none of that. For that reason, a lot of investors don't like gold. They are very focused on cash flow. And cash flow is very important, and I love cash flow. Um, so, why am I talking about? What am I talking about here? I'm basically talking about getting exposure to gold through an ETF, an income based ETF that will generate a decent monthly distribution. That ETF is NEOS's Gold High Income ETF, or IAUI. So, my objective is to share information about IAUI, and it'll provide you exposure to gold and deliver monthly income. It's an income based ETF. It generates, in my judgment, superior total return without NAV erosion. That's very important. I've done several videos on NAV erosion. I hate NAV erosion. I love monthly distributions. I love a weekly distribution if I can get it. But what I don't want is to get a distribution at the expense of the value of the underlying asset. That's not what happens here. Neos Investments does a very good job. They're innovative and they are responsible. So, a little bit about Neos. Their motto on their website is seeking income as the outcome. So, what you'll see when you do a little digging is that they have a focus on distribution yield, but the distribution yield is not exorbitant. So, for instance, SPYI, it's one of their flagship ETFs that has an options overlay strategy on the S&P 500. Has a distribution rate of 12.16%. Very respectable, very decent, not exorbitant. And like all of their ETFs, and I own SPYI, and I own QQQI, and I own BTCI. Their options overlay strategy is responsible. They sell options a little bit out of the money, and some of them around at the money, but they don't sell all of their holdings. So they do avail themselves to some upside, but they're optimizing that premium income, which is really what you want. Here's a list of all of their ETFs, and you can see it's broken out by 5 different families. Equity high income, you'll see SPYI and QQQI. They got a small cap one in there, IWMI for the Russell 2000. Hedged equity income, high income alternatives, and this is where we are here today. And I've already done the Bitcoin one, BTCI. Here we're talking about the gold high income ETF, IAUI. They have fixed income, and then they also have U.S. Treasuries. So here's the list of all their ETFs, and you will see the distribution rate for all of those ETFs. And when you look, I want to say about 2/3 of the way down the slide, you'll see the gold high income ETF distributes monthly, like all of them, and the distribution rate um, annualized is 12.63%. The assets under management, 127.7 million. So it's not huge, it's respectable. This is a smaller company. They're nimble and they're very innovative, and they're very sharp. They do a good job with their options overlay strategy. I want to say that the expense ratio is 78 basis points. So for every 10,000 you invest, it's $78 a year you pay, and I think that's pretty reasonable considering it's an income-based ETF with an options overlay strategy. All right, before we press on, a little housekeeping. What I say is not financial advice. This video is for information and education. It reflects my opinions, research, and experience as an independent investor for more than 30 years. So do your own research and due diligence before making any major financial investment decisions. So before we jump into the ETF, a little bit of background about physical gold. How is physical gold doing? Well, what I'm showing you here is this: the return, and it's really price return of physical gold. I'm comparing it to the total return of other leading investments today is 48.09%. So for 9 months, it's done pretty well. It's gone up nearly 50%. Um, and we've had years where gold didn't do anything; it was just kind of flat. But it's moving up. It's doing very well. Um, if you look at the entire list, the top two are the top performing assets year to date. It's the stock Seagate Technologies and then Palantir. Um, so respectively 190, almost 198%, then also a little under 129%. And then all the rest of them, and I'm not capturing all of the leading investments, but these are the important ones. Oracle, 73%, Super Microcomputer, 70%, physical silver, and that's actually outperforming physical gold, 66%. Physical silver is trading around $48 an ounce, which is phenomenal. And I own physical silver. I own physical gold as well. I also own Bitcoin, as you know. Um, so anyway, physical silver is doing very well. Taiwan Semiconductor, 49.5%. Physical gold, as I mentioned, 48%. The chip maker Broadcom, a little under 47%. Nvidia, a little under 40%. Google, 30%. Netflix, 29%. Bitcoin, this is just year to date, 29.36%. As I've mentioned before, Bitcoin is the best performing asset on earth for the last 10 years, 45%. And you could actually even go further out, and it's much higher. I think you can go back 13, 14 years. Um, anyway, Bitcoin, but that's just the year to date metric. Monster Beverage, 27%. If you were to go 10 years back, Monster Beverage is extremely high. Microsoft, we all know Microsoft, love it, 23%. Meta Platforms, 21.6%. And then we have a couple of the leading indices. The NASDAQ 100, year to date, 18%. The S&P 500, year to date, 14%. Tesla, 6.44%. Apple 3.4%, and then Amazon 0.05%. So why am I showing you this? I'm showing you this because gold is not an asset that should be ignored. Gold is widely recognized around the world as a permanent store of value. Gold, yes, it's a speculative asset, but gold is money. Like it or not, gold is money. And gold has been recognized as money for decades. Our US dollar used to be gold backed by gold. We were on a gold standard. We aren't anymore. And I'm going to get to reasons on why to invest in physical gold. But basically, it's money and it's a store of value. All right. So, why? Wealth preservation. Gold and silver are recognized globally as stores of value. They maintain purchasing power over decades, particularly during periods of high inflation and geopolitical turmoil. We all know that we still have inflation here in the United States. We had it much worse in the previous administration. We know that it was up around 9%, and that was a result of profligate government spending and really a funky monetary policy, but that happens. Gold is a hedge against that. And let me say that you don't invest in gold for it to be a moonshot, like a stock or, uh, the next Microsoft or the next Nvidia, actually, I should say. It's really insurance, and it's basically insurance against inflation, currency devaluation, those type of things. But I'll tell you what, when it goes up, that's nice. Uh, Another reason, portfolio diversification. It can reduce the overall volatility of your portfolio. Usually, the price of gold and silver move independently from other investments like stocks and bonds. Although it's interesting, Gold and silver have been going up. Bitcoin's been going up. Uh, the stock market has been going up. Everything is going up. But historically, they tend to move independently. I mentioned it's a hedge. It's insurance, but it protects against all sorts of risks like currency depreciation, currency devaluation. We're all familiar with quantitative easing, our monetary policy that we've had very in a very pronounced way since 2008. Uh, and China does it for trade purposes to make their exports cheaper. Those types of things. Banking crises, political instability, um, because gold and silver are tangible assets. They're not reliant on third party institutions like a bank or a Federal Reserve. Um, Also, let me just say this. I mean, you could actually throw Bitcoin in there. Bitcoin is money as well. It's very close to being perfect money because there's no inflation tied to it. But if you have a digital wallet, you're dependent on uh, not just keeping your wallet safe and your digital key safe, but also uh, the network where that digital wallet might be. And there's antidotes to that, but that's another video altogether. There's no risk of default with physical gold or silver, unlike paper assets, fiat currencies, stocks, um, ETFs, or whatever. There's no risk of uh, institutional insolvency or credit events. So there's no risk of default there. If you hold it, you own it. But there's other risks around that. I'll get to that in a little bit. Privacy and control. Investors have direct control and privacy over their precious metals. You can store them, privately in a safe in your home or in a vault. Just make sure they're secure. And if they're in a vault, you have a trustworthy custodian. And if you have it in a safe, good idea to have a little bit of insurance. What is the downside? No regular income, as I mentioned. It's a speculative asset. There's no cash flow, none. Um, you own physical gold or silver, you have to store it. There's a cost. You have to buy a safe. It has to be a good safe. You have to have a good idea to have insurance. If you don't have it in a safe, have it in a vault at a bank. That is not free. There is a cost for that. You need to also probably have insurance with the custodian at the bank as well. Um, it's not as liquid. It's also you may encounter challenges with precious metal dealers. Some of them are not always trustworthy. They may uh, overprice it when you are buying physical gold or silver. They may underprice it when you are selling it to them. They're in it to make a profit. And I've dealt with some of these guys. They are not uh, tightly regulated. It's kind of like the Wild West dealing with some of them. So that is a downside. Um, Physical gold and silver, there is more price volatility than with an ETF, especially an income-based ETF. Gold prices fluctuate significantly. They may, be flat for several years. We've seen that, but they can, go up and down, uh, often over extended periods of time. So anyway, that's just something that's really just kind of the nature of that beast. Tax treatment: if you sell your physical gold, it's going to be taxed as a collectible. If you hold it for more than a year, you're likely going to pay a higher um, capital gains rate versus if you're selling a gold based ETF. You own physical gold or silver, there is a risk of theft. There are people out there that are not good people. They may mean you harm and they may want to take what's yours. So there is that risk if they know you own gold and you store it in your house and they know where you live. Full disclosure, I do not own any in my house. So please stay away from my house. But if you do, I mean, that is a risk. It's good to have insurance and have a good safe. So, anyway, So why invest in a gold-based ETF? It's more liquid. A gold-based ETF trades just like other ETFs or stocks. You can buy it and sell it. You can get your cash. It's very liquid. The costs are lower. You do not have to pay for the storage or the insurance. It's convenient and safe. You open up your brokerage account. You look at your holdings. Um, and the regulation around the gold-based ETF is very similar, if not identical, to how stocks and other ETFs are regulated. It adds another dimension of diversification to your portfolio. As I mentioned, it's an effective hedge against market downturns and inflation. So it can act as lowering your overall volatility of your portfolio. It's very transparent. The share price of your gold-based ETF uh, should reflect the real time gold prices. So if the price of gold goes down, the price of your ETF will go down. It won't be exact because the price of your ETF will not be the same. You're not buying gold; you're buying the ETF, uh, and it's going to be even more direct if it's not a spot ETF, but if it's an income-based ETF. Uh, but it's very transparent. It should move in the same basic direction. I will say this: that the income-based ETF, uh, the price volatility is much more gentle than the spot-based ETF, and they're definitely more gentle than the price of gold. All right. Um, Other reasons, they're very accessible. You can buy as little as a single share um, and add that gold exposure very easily to your portfolio. Uh, and you know what? When you buy a single share of a gold-based ETF, no matter what the price is, it's not going to be $3,800 a share. It's going to be the price of the ETF, and they are very affordable. The tax treatment is more favorable. So if you sell your shares, gold-based ETF shares, the capital gains tax rates are lower. Um, so they just are. They're not treated as collectibles. They are treated as financial securities or ETFs. You can use your ETF as collateral if you are applying for a loan. Um, so that's just additional flexibility. That is an asset. All right. It's very compatible with your portfolio. It fits in there with your stocks and ETFs. You can move it around, trade it, increase it, decrease it at will. And with an income based ETF like IAUI, you get that extra dimension of getting a monthly distribution. You're getting income, which is nice. So here I'm showing you two of the gold based ETFs, the income based one by NEOS IAUI and the spot based ETF IAUM by BlackRock. I'm showing you these to basically just show you not that one is better. They're not. They're different. They do different things for your portfolio. Here you can see the latest closing price. The inception date. IAUM has just been around longer. Neos is a newer company. They're smaller. They're very innovative, but they're just smaller. And their focus is on generating monthly income. So if that's what you're about, you know, check out Neos. And even if it's not this one, check out their other instruments. They're pretty good. The expense ratio is higher, but there's an options overlay strategy. It's an actively managed ETF, so it's taking a little bit of work, and that's where that 78 basis points comes in. So for every $10,000 you invest, you pay $78 a year. I think that is money well spent. It's much less with a less actively managed ETF. It's 9 basis points where they're basically replicating movements of physical gold. I mean, aside from having a custodian, that's really all they're doing. Um, the strategy for IAUM is direct exposure. They own physical gold. Are holding it through a custodian in a vault, whereas Neos does not hold physical gold. They are holding derivatives. They hold other spot gold ETFs. They don't hold IAUM. They hold others, and then they also are writing options against uh, other spot spot gold ETF. So I'm going to get into that in a little bit. I'm just sharing the returns here. Kind of not fair to do that because there's only 4 months here with IAUI. They just haven't had a full year. They have 4 months. So um, I extrapolated that over a year, the total return for 1 year for IAUI would probably be anywhere between 27 and 30%. So it's not going to be as high as the spot gold ETF, which is 45%. Um, Keep in mind that we're in a bull market for commodities. And so IAUM has been going up because the price of gold has been going up. So there's that more greater sensitivity to those movements. If all of a sudden gold becomes bearish, IAUM will go down. Now IAUI is not as sensitive to price movements. It's more gentle, and again, you're going to have that income component monthly. So that's the difference. So the dividend yield for 4 months is, or the distribution yield is around 4%. We saw a couple slides ago. If you annualize that, it's around 12.63%. There is no distribution with IAUM. It is all price performance in the market. So why would I invest in IAUI? And I'm seriously considering it. I don't own it yet, but like I said, I own SPYI, QQQI, and BTCI. I like Neos's strategy. But why would I invest in it? And if you're interested, this is my thoughts on that. Not advice, but I believe in gold. I invest in gold. I'm a dividend and growth investor. Um, both of the ETFs I just shared with you will enhance your exposure to gold. It'll broaden it indirectly, not directly, but indirectly. IAUI, which I'm looking at, uh, adds more, would add more to my monthly distributions with less volatility. I like IAUM. I like BlackRock. I will not likely invest in it because I don't need to. I own physical gold, um, but it's a perfectly fine ETF if you're interested in getting that exposure to gold without owning physical gold. It's something to think about, and it will. Uh, if you owned it, your portfolio would be returning great benefits to you. So I talked about a lot of these points here on IAUI, but what I will hit a little bit harder here is that IAUI, to generate its income, it invests in fixed income and commodity markets. So for its fixed, and it's really two pieces. So for its fixed income portion, it's investing in U.S. Treasury security. So T bills, T notes, T bonds, um, and then it's for its commodity portion, it's investing in derivatives through which are primarily the spot gold ETFs. So they're not investing in IAUM through BlackRock, which is fine. They're investing in Goldman Sachs's AAAU physical gold ETF. And I didn't write this down here, they use derivatives such as options to create its portfolio. So they're actually writing call options and uh, put options against another spot gold ETF, gold, GLD, and that is by um, State Street Bank. And it's a spider ETF, if you will. And I'll show you that when we go through the holdings briefly. All right. So, what are the goals of IAUI? Three goals: downside protection. So you're mitigating um, basically any downturns in the market. So if the price of gold goes down, you're cushioning your return because you're getting that monthly distribution, income distribution, closely related. You're enhancing your overall yield through their options overlay strategy that I just mentioned. And through this, you're really minimizing any disruptions to your portfolio. It's a way to mitigate your risk. So that's that. A little bit more about the holdings. I already mentioned this, but I'm going to go through this quickly. They don't invest directly in physical gold; it's indirect. They invest in spot gold ETFs. They have the options overlay strategy, and I'll just say one thing about it. What Neos does very well is their strategy is primarily where they're selling options uh, slightly out of the money or around at the money. So they're trying to optimize their premium income, but they're not putting all their holdings up front. They're very strategic in how they're doing that. So there is still some upside there. There's going to be less upside, obviously, much less upside than with a spot gold ETF, but you're going to get that income. And so this is just a matter of preference. If you want both, then you may need to invest in IAUI and a spot gold ETF or in physical gold, like I do. Something to think about. Treasuries and cash, they have large allocations of T bills as well as cash and cash equivalents to manage liquidity needs and collateral requirements for options activities. So, why would they do that? If they're writing put options, they need that cash, or they need to be able to convert to cash. They don't have any physical gold in custody. They have just spot gold ETFs. Here's just some basics on IAUI. They closed yesterday at $52.59. The yield is around 4%. It just varies day by day depending on the price of the ETF. They pay monthly. I already mentioned the expense ratio is 78 basis points. The holdings, primarily government securities, but also derivatives. And I talked about those derivatives. Here's a little bit more detail. So T-bills, a little under 55%, but then you have your Goldman Sachs physical gold ETF, AAAU, and then they have a bunch of options. They have 3 call options written on GLD, which is the Spider Sector Gold ETF. Um, and then they have some more treasury obligations. Then they have a put option. So those are their basically, that's how they're generating those extraordinary distributions. So, and I just wanted to show this. I don't need to go too deep in this, but this is the derivative that they invest in. And if you're interested in other spot gold ETFs other than IAUM, there's AAAU, and it closed at around $38 a share. Um, they like the low expense ratio, and that's why they invest in that. But it, again, it doesn't pay a distribution. It's a spot gold ETF. And then the one that they're writing the options against, as I mentioned, is gold. It's a Spider uh, gold ETF, GLD. It's much more expensive, but it's more liquid, so they can get in and out of it very quickly. All right, that's for the options. Just a little bit of information. I already touched on this. The dividend yield, it's around 3.99%. They pay monthly. They've only been around for 4 months, but these guys are really good. And so basically, the monthly distribution is going to be a little bit over 50 cents a share. That's just been the history. They paid out 4 of them. And here's just a table. Same thing. And and I'm showing you this because I want to drive the point home that with IAUI, they've only been doing this for 4 months, so the orange line, but they already have almost 10% total return, more than half of the S&P 500 for 12 months, and almost half of the Nasdaq 100 for 12 months. So this is only for 4 months. These guys are doing pretty good. As I mentioned, I extrapolated for 12 months, and I'm projecting it would be around 26, 27% total return, less than the spot gold ETFs. But again, you're getting a distribution monthly. You don't get those with the spot gold ETFs like IAUM or GLD or AAAU. You just get more market movements, price performance. And folks, that is it. I hope you found this to be useful, informative, and enjoyable. And before I close, Friendly reminder that as an affiliate partner of Seeking Alpha, I can offer discounts for their premium subscription, Alpha Picks. You get 2 free picks every month. And then the bundle, which is a little bit of both. I like premium. I mean, I get them both. Uh, I love those 2 picks. They kill the S&P 500. I like premium because I'm getting great insight into any and all stocks and ETFs that I consider buying, and the information is up to date and the analysis is spot on. You can see the links and the QR codes. You can read a little bit more detail on these offers. You can go right to the links or the QR codes and sign right up. Premium 7-day free trial. If you do not like it, you can cancel before 7 days. No obligation, but I think you will like it. Check out those discounts. And you know what? If you want more dividend or investment content, we are on X, Instagram, and on Facebook. Until our next video, have a wonderful day. God bless.